Hey, my name's Rajesh. I am a lender, a direct lender based in Los Angeles, California. And today I want to talk about should you ever or should I ever buy points, or should I just increase the down payment? And by points, I mean discount points. So normally when lenders quote you uh, an interest rate, what they're telling you is if you pay nothing extra other than the origination fee and third party closing costs, this is your interest rate based on the qualifications of this property, based on the income producing potential of this property, as well as your credit score. So if you have a high credit score, you get a lower base interest rate. If you have a lower credit score, you get a higher base interest rate. And when it comes to DSCR loans for commercial multifamilies, when I say lower credit score, I'm generally speaking of nothing less than 700, and in some cases nothing less than 720. Now, if you have a 750, a 780, an 800, your credit score, your interest rate, excuse me, your interest rate actually goes lower. So that's a win over there. But a real easy way to take a look at this is to just look at the monthly payment. Excuse me. One of those times when I gotta sneeze, but I can't for some reason. It's just really weird. Anyway, so we're gonna just say, let's come up with some numbers. Let's say a 2.5 million, a 2.4 million dollar property. Let's say it's 8 units, 1 unit vacant, 14,975 in gross rents. That includes the vacant unit, and then the vacant unit, or not including the vacant unit, and the vacant unit earns about 2,400 a month. Depending on the product we go with, we can either count. Let's see here. Yeah. So let's say 75%. So we're going to use 75% of the rent from the vacant unit of which is based on market rents, and for that we apply a vacancy discount so that we can actually um, get an estimate of what it's going to cost. I'm not even going to worry about third-party insurance costs. I believe the goal of every multifamily investor that I like to work with and that I have worked with, and this also goes for my own properties, is that I like to put as little down as possible, not because I believe it's spending money, but because I like liquidity. And let's say I have, I don't know, $1 million liquid. Now, if I were to put that entire $1 million down on one property as a down payment, and let's see what that looks like here. I go there and I put $1 million down on that one property. Now I'm only able to buy one property. Whereas if I go to a property where I put down $500,000, right? Oops. 100020. Good enough. Yeah, so if I put down $500,000 on one property, and in this case 600,000, now I still have money left over for repairs, rehab, emergencies, or buying a second building. And when I have two buildings appreciating, I'm making more money than if I just had one building appreciating. So that's the way I like to look at that, because now I have two buildings that are collecting rents and paying for themselves, instead of just one building collecting rent and paying for itself. Um, and when I do this, I also want to get the lowest interest rate possible, because lower interest rates means lower monthly payments. And if I have lower monthly payments, that means I'm cash flowing more, which means less money out of my pocket, if anything. That means because the rents are covering the mortgage and the other operating expenses. So what do I have to do to make that happen? One way, of course, is to, get a DSCR loan. And in this case, as opposed to a bank loan, because with a bank loan, we're basing that off of NOI. So we look at the net operating income and we divide that by the total debt service or monthly payments. And in our case, we can actually go as 1.15 DSCR ratio, and that means you'd have to put down roughly $960,000 to get, I believe it's 2.5 points or 2.25 points above the 5-year CMT right now. So when I checked yesterday, we were at 5.93% at 1.15. And so that means you ended up having to put down roughly $970,000. Your monthly payment was $85.26, and your net cash flow was about $12.71. So you're still making money on this building, on a $2.4 million building, and you're making $12.71. But if you're looking at this as a permanent source of income to replace your job, that's not LA. That's Midwest. That's Texas. That's Florida. That's Northeast, some parts. That's not Los Angeles. Los Angeles is based. It's an equity game. You just want to be able to cash flow enough so that the property can appreciate pretty quickly. And I'm not saying don't do this. Like, let's say you were to increase your down payment to 50%, or 50%. Your interest rate is not going to change much. Your monthly payment will go down just because the loan amount is smaller, and your cash flow is going to go up by about $1,000 up to almost to a little over $2,500 a month. You're at $2,671. But the point I want to make is you can do that by increasing down payment, making sure the place is fully occupied, and going for a bank loan, which out of pocket you're spending about $1.2 million. Or if you're like me, you want to spend as little as possible and still get the same interest rate. And with the DSCR loan on commercial multifamilies for between 5 to 8 units, all you need is a 1.1 DSCR ratio. But we're basing that off of gross rents. We're basing that off of gross rents as opposed to 1.15. Yeah. Oh no, we were going 50% down here. Yeah. So that's 26, 28. So we go off of gross rent. So we look at the gross rents and then divide that by property taxes, landlord insurance, and the monthly payments combined. So as you can see here, if I were to line these up and I put 67% right here, your DSCR ratio, your net DSCR ratio is 1.024, but the same down payment would result in a higher DSCR ratio, higher gross DSCR ratio, which is 1.1. And the beauty about that is that you can use the difference in payment to buy down the interest rate, which would sometimes just be cheaper than putting that amount of money down. Because at 1.1, to buy a 5.875% interest rate, what you need to do is put down at least 30%, right? And hit 1.1. Now, at 1.2, you get a 6.875% interest rate right now without having to buy any points. But you still need to put at least 30% down. So you're going to look at the cash flow and you're like, I'm losing $1,300 a month, right? But I only had to put down $712,000. Now let's say I get that 5.875% interest rate, and I go with minimal down payment, and I go interest only. Now my down payment requirement, just to make the same $2,600 a month in cash flow, you're looking at $933,000 versus $1.2 million. So if you have $1 million liquid, you're not going to qualify for the bank loan because, one, you have one unit vacant on this building. They require a minimum of 100% occupancy at the time of closing. And if you're not the owner, how are you going to get the seller to put in a tenant that you've qualified in that building? I'm not saying it can't be done. I'm just saying it's easier to put in a tenant in the building when you own the building. Um, when you don't own the building and you've got a vacancy over there, uh, you want to be able to uh, still get a comparable interest rate while still putting in less money down. So honestly, the loan amount here, by the way, would be roughly $1.5 million. And this would, let's say it costs you 5 points, right? 5 points, and you got $1.5 million times 0.05 percent. No, that's not right. 5% of the loan amount. Yeah, so 1.5 million times 0.05 is $75,000. So $75,000 plus 933 plus 933. We're looking at about 1,080,000 or 8,000, 1,008,000 right there. In terms of cash to close, not counting other closing costs. But the beauty is that on a property that costs $2.4 million, you're going to be like, all right, I want the property for $2.4 million, but I want $75,000 closing cost credits. So now your real purchase price is $2.3 million, $2.325 million, and you're going to tell the seller, hey, I want a lower purchase price. Let's buy it at 2.3 million. It's going to be no, 2.35, and you're going to be like, no, I want let's settle in the middle somewhere. Let's say it's 2.325, and the seller is like, okay, and so you're going to tell him, okay, great, but I want that $75,000 as seller credit. So the purchase price is still going to say 2.4 million. The seller's agent's happy because that means he's going to get his full commission. The buyer's agent is happy because they're going to get their full commission based off the $2.4 million purchase price. You're making your down payment based on the $2.4 million purchase price. But your interest rate is going to, but the discount points are going to be paid for by the seller. You're essentially financing the cost of the discount points. So you're getting an interest rate of 5.875%, and now you're still cash flowing to $2,600 a month, and you're not having to do as big a down payment. You're saving actually about $300,000 that gets to stay in your account. Now I know you're saying this is not a fair comparison because this one's interest only, this one's not interest only. You're absolutely right. If we were to get rid of interest only here, you're cash flowing $1,100 a month, and if you were to do interest only here, you would be doing $3,800 a month. But you can always do a refi later, say a year or two from now, because by doing that, you still get your hands on the property, and when the property appreciates in value, now you don't have to worry about paying that extra down payment out of pocket in cash that gets to stay liquid in your bank account. What you really get to do is you get a property at a much lower down payment, you get the lower interest rate, the higher cash flow, and when you do the refi later, any closing cost comes out of the equity in the property after the property has appreciated. So this is just one strategy that you can use, and that I've seen my clients use, and that I myself have used when purchasing multifamily properties, especially in the 5 to 8 unit space, because again, our goal is to lower the down payment, lower the monthly payment, and increase the cash flow as much as possible. And I'll tell you why I believe this is a better strategy. Because let's say you're at 8.125 and you put 50% down, okay? Because you're not able to get the building fully occupied while you're not the owner. It's just much harder. And so you do that, your interest rate at best maybe 7.99%. And we're still at that 50% down, right? And yeah, you're cash flowing $965. You put down almost 1.2 million, which is still $300,000 more than you had with 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 just by buying points. So buying discount points allows you to get a lower interest rate, lower the monthly payment, keep the down payment low, and finance the cost of those discount points, as well as increase your cash flow, making it easier when you want to go refinance in the future. So if that's something that's interesting to you, let me know in the comments. Thank you.